Advanced accounting concepts are crucial for understanding a company's financial health. These concepts are not just for accountants, but for anyone involved in financial decision-making. They provide a deeper dive into financial reporting, offering insights that go beyond the surface level. These concepts go beyond basic accounting principles, delving into more complex areas that require a nuanced understanding. They offer a more comprehensive view of a company's financial position, helping stakeholders make informed decisions. One key area is revenue recognition, which is fundamental to accurate financial reporting. This involves understanding when a company can record revenue, ensuring that it aligns with the actual delivery of goods or services. It ensures that revenue is reported in the correct accounting period, which is crucial for maintaining financial integrity. Another important area is provisions and contingencies. These are essential for preparing for potential future obligations and uncertainties. These deal with potential future obligations and uncertainties, helping companies to plan and mitigate risks effectively. Finally, we have accounting for leases, a critical area that impacts both lessees and lessors. This area addresses the recognition and measurement of leases, ensuring that they are accurately reflected in financial statements. Understanding these concepts is essential for anyone who wants to truly grasp a company's financial performance. Mastery of advanced accounting principles can lead to better financial management and strategic planning. Revenue recognition is a fundamental accounting principle. It determines when a company can recognize revenue in its financial statements. This process is crucial for accurately reflecting a company's financial performance. It ensures that revenue is recognized when it is earned. The timing of revenue recognition can significantly impact a company's reported profitability. Recognizing revenue too early or too late can distort the true financial picture. This can mislead investors and creditors. Therefore, understanding the principles of revenue recognition is essential for all stakeholders. IFRS 15 outlines a 5-step model for revenue recognition. This model provides a structured approach to determine when to recognize revenue from contracts with customers. The 5 steps are: first, identify the contract with a customer. Second, identify the performance obligations in the contract. Third, determine the transaction price. Fourth, allocate the transaction price to the performance obligations in the contract. And fifth, recognize revenue when or as the entity satisfies a performance obligation. This model ensures that revenue is recognized in a consistent and reliable manner. It promotes transparency and comparability in financial reporting. Revenue can be recognized over time or at a point in time. This depends on the nature of the contract and the performance obligations. Revenue is recognized over time if the customer simultaneously receives and consumes the benefits of the entity's performance. For example, a construction company building a bridge over several years would recognize revenue over time. Conversely, revenue is recognized at a point in time if the customer obtains control of the asset at a specific point. An example is a retail store selling a product to a customer. Section 5. Provisions and contingencies, preparing for the unexpected. Provisions and contingencies are essential aspects of financial reporting. They deal with uncertainties and potential future obligations. These uncertainties can have a material impact on a company's financial position. Provisions represent liabilities of uncertain timing or amount. They arise from past events and are recognized when it is probable that an outflow of resources will be required to settle the obligation. Contingencies, on the other hand, are possible obligations or assets whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events. Section 6. Provisions, accounting for known unknowns. In this section, we delve into the intricacies of provisions and how they play a crucial role in financial accounting. A provision is a liability of uncertain timing or amount. It represents a future expense that a company anticipates but cannot pinpoint exactly when or how much it will be. It's recognized when an entity has a present obligation, legal or constructive, as a result of a past event. This means that the company is already committed to a responsibility due to something that has occurred previously. 2, it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. In other words, it is likely that the company will need to spend money or resources to fulfill this obligation. And 3, a reliable estimate can be made of the amount of the obligation. This means that the company can reasonably predict the cost associated with the obligation. For example, a company might have to recognize a provision for warranty claims. This is a common scenario where provisions are necessary. This is because the company has a present obligation to repair or replace defective products. The obligation arises from the company's commitment to its customers. The amount of the provision would be based on the estimated number of claims and the cost of repairs or replacements. Companies use historical data and trends to make these estimates, ensuring they set aside enough resources to cover potential future claims. Section 7. Contingencies. Navigating the realm of possibilities. A contingency is a possible asset or obligation. Its existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the entity's control. Contingencies can be classified as either possible or remote. A possible contingency is disclosed in the notes to the financial statements. A remote contingency is not disclosed. For example, a company facing a lawsuit would have a contingency. The outcome of the lawsuit is uncertain and could result in either a gain or a loss. Section 8. Leasing, unveiling the ins and outs of IFRS 16. IFRS 16 establishes principles for the recognition, measurement, presentation, and disclosure of leases. It ensures that lessees and lessors provide relevant information about leasing activities in their financial statements. This standard aims to enhance transparency and comparability in lease accounting. IFRS 16 introduces the concept of a right-of-use asset for lessees. It requires lessees to recognize a right-of-use asset and a lease liability for all leases except for short-term leases and leases of low-value assets. This approach reflects the economic reality of leasing arrangements. Section 9. Lessee. Accounting, a tale of assets and our liabilities. In this section, we delve into the intricate world of accounting for leases, a crucial aspect for businesses of all sizes. Under IFRS 16, a lessee recognizes a right-of-use asset and a lease liability at the commencement date of the lease. This standard has revolutionized how leases are accounted for, bringing more transparency and consistency to financial statements. The right-of-use asset represents the lessee's right to use the underlying asset for the leased term. This asset is initially measured at cost, which includes the amount of the initial measurement of the lease liability, any lease payments made at or before the commencement date, and any initial direct costs incurred by the lessee. The lease liability represents the lessee's obligation to make lease payments over the lease term. It is initially measured at the present value of the lease payments that are not paid at the commencement date, discounted using the interest rate implicit in the lease, if that rate can be readily determined. For example, if a company leases an office building for 10 years, it would recognize a right-of-use asset for the building and a lease liability for the lease payments. This ensures that the financial statements reflect the economic reality of the lease arrangement. The right-of-use asset would be depreciated over the lease term, typically on a straight-line basis, reflecting the usage of the asset over time. Meanwhile, the lease liability would be reduced as lease payments are made, with interest expense recognized on the liability. This dual recognition of assets and liabilities provides a more accurate picture of a company's financial position and performance. Section 10. Lessor accounting, the other side of the lease. For lessors, IFRS 16 largely carries forward the accounting requirements from previous standards. Lessors continue to classify leases as either finance leases or operating leases. The classification depends on whether the lease transfers substantially all the risks and rewards incidental to ownership of the underlying asset. If the lease is classified as a finance lease, the lessor recognizes finance income over the lease term. If the lease is classified as an operating lease, the lessor continues to recognize the lease payments as income on a straight-line basis over the lease term. Section 11. Conclusion. The importance of accurate accounting. In conclusion, understanding advanced accounting concepts is crucial for anyone involved in financial reporting or analyzing financial statements. Revenue recognition, provisions and contingencies, and lease accounting are all complex areas that require careful consideration. By grasping these concepts, stakeholders can gain a deeper understanding of a company's financial performance and position. Accurate accounting is essential for making informed business decisions. It ensures transparency and accountability in the financial markets.